Right now, within the United States, we are seeing the highest level of auto loan debt that we've ever seen in our country, and by a long shot. We're currently sitting at $1.66 trillion in debt for auto loans across the country.
I bought my dream car. It's the most powerful four-word sentence on YouTube. When you see Whistling Diesel taking a literal saw to a brand new Ferrari, or the Stradman unveiling yet another purple hypercar to his fleet, it feels like the natural order of things. We watched Supercar Blondie reveal $10 million concepts, and Matt Watson at Carwow drag race vehicles that cost more than most houses, all while the views climb into the billions. But there's a massive gap between the dream car content in your feed and the reality of the parking lot at your local grocery store. We've been conditioned to believe that $100,000 trucks and $1,500 monthly payments are just normal. Car loans have completely gone off the rails, and most people don't notice because the entire system is built around one trick: focus on the monthly payment, not the total cost, the interest piling up, or the fact that you're locking yourself into 7 years of payments on a car that's losing value every day. Just the monthly number. Make that look manageable, and most people will sign without thinking twice. It's the greatest magic trick in the history of the auto industry. But once you see behind the curtain and realize what that 84-month loan is actually doing to your net worth, you'll never look at this the same way again.
The average new car in November sold for $49,814. We expect it to cross the $50,000 line sometime early this year and stay there.
The most important thing to understand about the modern car loan market is this. It is not built around the total price of the car anymore. It is built around the monthly payment. Once that happens, almost any number can be made to feel reasonable. A car that should feel out of reach suddenly sounds possible if the salesperson says it's only a few hundred more per month. A loan that should feel dangerous sounds normal if the term gets stretched to 72, 84, or even 96 months. The pain gets delayed, and the buyer gets the car today. That is why one of the most revealing ideas in this whole debate is not even a statistic. It is a mindset. Doug DeMuro puts it in a way most people instantly understand when he says, "I only see cars as total cost of ownership."
I think this goes into my total cost of ownership thing. Like, I only see cars as total cost of ownership.
This matters because it cuts directly against the way cars are sold. In most dealerships and online finance calculators, the goal is to get you focused on the monthly number, not on the total cost, the total interest, or the years of your life you are committing to that payment. And the market data shows just how powerful that monthly payment thinking has become. In Q4 2025, Edmunds said 20.3% of financed new vehicle purchases came with payments of $1,000 or more per month, which is a record. It also reported that 84-month plus loans made up 20.8% of financed new car purchases in the same quarter. That means this is no longer a fringe behavior. This is mainstream. People are not only borrowing more, they are borrowing for longer, at rates that are still relatively high, to make those monthly payments feel survivable. Edmunds also noted average new car APRs in Q4 2025 were 6.7%, and 0% financing remained rare. That matters because long loans at low rates are one thing. Long loans at normal or elevated rates are a completely different story. The result is a car market where many buyers are not buying a vehicle, they are buying a payment. This is where the problem stops being about bad decisions and starts becoming a structural affordability issue. Experian's Q3 2025 figures show average new car loan payments at $748 and used car payments at $532, with average loan terms of about 69 months for new cars and 67 months for used cars. It also shows how used car buyers get hit with much higher average interest rates than new car buyers, 11.40% versus 6.56%. And much higher rates still for subprime and deep subprime borrowers. So even before someone makes a mistake, the math is already hard. If you are buying used because you are trying to be more responsible, you can still get punished by a high rate. If you have weaker credit, the rate gets even worse. If you put little money down, the loan balance stays high. If the car depreciates fast, you can end up underwater early. And if anything goes wrong, a repair bill, job loss, insurance increase, or family emergency, the loan does not care. That is why this issue hits regular people much harder than the internet sometimes makes it look. Online, it is easy to focus on the dramatic examples, the influencer car collections, the exotic leases, the giant trucks. But the real pressure is often on normal households trying to buy reliable transportation in a market where reliable transportation has become expensive. Even the Federal Reserve has acknowledged how price and payment pressure fed into delinquency stress. In a 2025 note, the Fed said larger amounts financed and higher interest rates caused monthly auto loan payments to rise nearly 30% between 2020 and 2023, contributing to higher auto delinquency rates. That is not just a people are irresponsible story. That is a system where the cost of entry got pushed up, and financing became the bridge people had to use. The most dangerous part of this market is not the first loan. It is what happens after the first loan. This is the negative equity cycle, and once someone falls into it, getting out can take years. A buyer gets a long-term loan to keep the payment low. The car depreciates faster than the loan balance drops. A year or two later, they want a different car, or need a different car, or the current one becomes expensive to maintain. They trade it in, but the trade in value is lower than what they owe, so that unpaid amount gets rolled into the next loan. Now the next car starts with debt from the old car already attached to it. That is how somebody ends up financing one vehicle while still paying for the last one in disguise. People talk about this exact pattern all the time, financing cars for 6 or 7 years, getting tired of them early, then rolling negative equity into the next deal. It sounds exaggerated until you realize it happens constantly. And once you understand that, a lot of the market starts to make more sense. Why do some people seem to be driving expensive cars they should not be able to afford? Because the transaction is often not a fresh purchase. It is a chain of trade-ins, rolled balances, stretched terms, and monthly payment optimization. From the outside, it looks like consumption. From the inside, it is often debt management. This out-of-control market isn't happening in a vacuum. It's being fueled by a lifestyle that's impossible for 99% of people to sustain, but is presented as entry-level every single day. When Matt Armstrong or Tavares buy a totaled McLaren to budget build it, or Cletus McFarland and Hoonigan burn through sets of tires that cost more than a mortgage, it warps our sense of what vehicle ownership looks like. We see Adam, Ozzy, and TJ Hunt rotating through wide-body builds, while Rory Reed at Auto Trader and the guys at Throttle House make a 6-figure SUV feel like a basic necessity. Even the educational or relatable side of YouTube, from Chris Fix and Scotty Kilmer to Donut Media and Engineering Explained, centers around a world where the cars are always the main character. Whether it's the vlogs of Shmee 150, Daily Driven Exotics, and Vehicle Virgins, or the technical builds of B is for Build, Amelia Hartford, and That Dude in Blue, we are constantly sold the idea of more. What the average viewer doesn't see are the commercial business write-offs, the high-leverage corporate leases, and the tax structures that make these fleets possible for a business. The danger is that regular buyers are bringing that same new car, new content energy to their local dealership, trying to finance a YouTube-sized lifestyle on a 9-to-5 budget. One reason this topic hits so hard online is that people recognize the pattern immediately. Not everyone can explain loan structuring or delinquency trends, but almost everyone understands when a deal sounds insane. In one Reddit discussion, a user said, "I got offered a loan on my Jetta for 84 months. I bought it when it was 8 years old. The whole point was that it was a cheap car that I didn't want to pay on at all." That is the entire problem in one sentence. Financing is no longer just helping people buy more cars. It is now being used to make almost any purchase look possible, even when the financing term itself is absurd for the age or value of the vehicle. A cheap car is supposed to reduce financial pressure, but if the loan term gets stretched too far, even the cheap car starts behaving like a financial anchor. That is also why the tone of these conversations has shifted. A few years ago, long-term loans were treated like a niche option. Now people talk about them like a normal feature of shopping. That change in tone is a warning sign by itself. When the market normalizes extreme financing, it becomes harder for buyers to tell the difference between flexible and dangerous. This is where the story needs nuance, because the truth is more useful than the loudest headline. It is easy to say everything is collapsing. It is also easy to say people have always financed cars. Nothing new here. Both are incomplete. The Federal Reserve's 2025 analysis said auto loan delinquencies had started to flatten in the quarters leading up to 2025 Q3, but also noted they picked up in the third quarter, and that pressure was rising more for some lower income groups and non-prime borrowers. The New York Fed's February 2026 release similarly described overall non-mortgage delinquency rates as having leveled off, while household debt continued to grow and lower-income households faced more strain. So the better way to say it is this: the market is not one big uniform disaster, but it is increasingly split. Higher income buyers with strong credit, cash reserves, and better rates can still play the game safely. In fact, Cox Automotive explicitly noted that wealthier households are helping support the higher end of the market. That helps explain why expensive vehicles can still move, even when affordability looks terrible on paper. But for everyone closer to the margin, the same market feels very different. High prices, high payments, limited 0% offers, and expensive used car APRs create a setup where one bad decision or one bad year can turn a car into a long-term financial problem. That split is what makes modern car financing feel out of control. It is not just about the size of the loans. It is about how uneven the risk has become. One group is using financing as a tool. Another group is using financing as a survival strategy. Those are not the same thing. Now, a lot of people hear car loans and think this is just about personal finance habits, but cars are not optional for many households. In most places, they are how people get to work, school, appointments, and everything else. So when car financing gets distorted, it affects much more than the auto market. It affects job flexibility, because someone buried in negative equity cannot easily downsize. It affects household budgets because a high payment, plus insurance, plus fuel, plus repairs can squeeze out savings. It affects financial resilience, because when an emergency happens, there is less room to absorb it. And it affects future decisions, because bad auto loan history can make the next loan even more expensive. That is why this topic feels bigger than just car people complaining about prices. It is really about how debt gets normalized when the underlying product becomes less affordable. Doug DeMuro, in his latest podcast at the Iced Coffee Hour, showed this mindset in clear cut when they talked about hypercar leases. Doug mentions a friend who leased a Koenigsegg and says his payments were like 30 G's a month. Crazy?
He leased that Koenigsegg. His payments were like 30 G's a month. Crazy.
It is obviously an extreme example, but the logic behind it is the same logic used in everyday car sales. Structure the deal, manage the payment, defer the pain, and make the number feel acceptable. The scale changes. The mechanism does not. That is the unsettling part. The same financing psychology exists at every level of the market. The strongest part of this story is not just that car loans are expensive. Everyone already knows that. The real thing worth talking about is how the market has slowly made conditions feel normal that should honestly still feel shocking. A $50,000 average transaction price for a new car. Record monthly payments. Record amounts financed. 1 in 5 new car loans stretching past 84 months. These are not numbers from some financial crisis headline. They are just the current state of buying a car in America. Presented like routine market updates, talked about like they are no big deal. And that is exactly the problem. Once something stops feeling unusual, people stop pushing back on it. The monthly payment mindset takes over completely. Buyers stop asking how long they are actually going to be paying. And lenders and dealers get more and more room to stretch deals further than they ever should have gone. Negative equity stops feeling like a red flag and just starts feeling like part of the process. Until one day, someone wakes up and realizes they do not just own a car, they are trapped in a financing situation they have no easy way out of. That is what out of control actually means here. Not that every single loan is a disaster, and not that every buyer is headed for ruin, but that the system has gotten really good at hiding what things actually cost until after you have already committed to them. And the reason this conversation keeps blowing up online is that more and more people are starting to feel that gap between what the car is actually worth to them and what the financing is quietly costing them over time. That gap is where all the stress lives. And it is why car loans have become one of the most obvious examples of how consumer debt can look totally fine on the surface while becoming harder and harder to actually live with underneath. Tuna No Crust, signing off.